Japan is back. Its economy is on its way to growth, with corporate profits remaining high and wages keep rising. We have seen CPI inflation rates overshooting the price stability target of 2% for 45 months in a row, leaving deflation behind us at last. Our financial industry is back on the global stage, and moreover, political stability is restored or reinforced after the historic victory won by the Prime Minister last weekend. Therefore, even for a conservative former central banker like myself, who has seen many false dawns in the so-called the lost 3 decades, it appears that this time is different. So, what should the guiding principle be in a new era for FinCity.Tokyo in promoting Tokyo as a financial center? Our objective is not to replicate the base of the powerful fleet to Japanese banks, as was the case in the 1980s. That is not our intention. Instead of pursuing dominance, we aim at promoting innovation in financial services and advancing policies to address social challenges and thus contribute to sustained growth both at home and overseas. You see, the yen and the sterling remain as stable reserve currencies. These non-dollar reserve currencies will have to collectively function to fill the gap created by the US as they recede from the international arena under its America First proposition. What this suggests is that financial centers like Tokyo and London, built on the foundation of democracy and rule of law, are well positioned, I think, to grasp new responsibilities, new opportunities in shifting global financial landscape. As I mentioned, Japan is back on its growth trajectory, but to make it sustained, we need well thought out growth strategy. Growth strategy was the third arrow of Abenomics that needed to fly faster and higher. The government's policy plan for promoting Japan as a leading asset management center is a pillar for growth. I think will add a new investment chain to what has been a bank-centric economy. Growth capital provided by this channel will help support firms that have potential to grow one day into unicorns. Inward investment in Japan will also enhance the role of the yen as an international currency. In this context, I want to raise two possible areas for future collaboration between the financial centers of London and Tokyo. The first is utilization of an Emerging Managers Program, or EMP, which is a part of the policy plan. And an emerging manager typically refers to a small, active, independent manager with relatively short track record, but who has high investment skills. The idea of EMP is systematically provide emerging managers with better chances to demonstrate their skills. FinCity.Tokyo supports emerging managers all year round, connecting with institutional investors. And every year, we host the Tokyo Asset Management Forum to showcase the distinctive managers who can serve catalysts for upgrading the Tokyo Financial Center. One is upgrading the transition bonds, the market for transition bonds. The intention is to support hard-to-abate industries that cannot leap directly from brown to green to realistically transition to achieve net zero goals. The cumulative amount of transition bonds issued by Japanese firms reached 1.4 trillion yen, or $9.5 billion. I hope our experience proves useful for the UK's own designing of transition finance. The other topic we want to explore together with London is interoperable voluntary carbon credit markets, which is one form of transition finance. We have been actually working with partners in the Asia-Pacific region to develop a network of interoperable carbon credit markets so that carbon credit generated through, in my view, the initiative could in the future be expanded to connect with carbon markets in Europe. And that is where I see potential for new collaboration between FinCity.Tokyo and London's Transition Financing Council.
This initiative started in 2023 and forms a crucial part of the government's growth strategy. It is aimed at contributing to economic growth through an increased flow of household savings into productive investments. As Minister Katayama mentioned in her message earlier, this initiative has yielded tangible results. Indeed, Japan is now at the turning point. It's the long-standing deflationary cost-cutting economy is finally over, and it is moving toward a growth-oriented one, supported by increased investment and higher productivity. As part of this, the government plans to expand the current initiative to promote Japan as a leading asset management center and develop a new comprehensive financial services strategy by the summer. Let me introduce to you the recent progress made and some next steps currently under consideration. One of the next steps is further enhancement of NISA. NISA is a tax exemption scheme for retail investors on capital gains and dividend income in Japan, originally modeled after the UK's Investment and Savings Account, ISA. The tax amendment plan for the fiscal year starting this April includes a proposal to remove the age restrictions for NISA's installment type scheme. This would allow for households to have NISA accounts for their children under the age of 18. The plan also proposes that investment trust focused primarily on bonds be included in NISA-eligible investment trusts, in addition to those focused primarily on equities. This would incentivize those with relatively low risk tolerance to take their first step to start investment. The second area for further steps is corporate governance reform. Since its introduction in 2015, the FSA has promoted strengthening of corporate governance through revisions to the Corporate Governance Code, with a view to improving Japanese companies' corporate value in the medium term. Thanks at least in part to these efforts, corporate mindset appears to be changing in Japan. As the minister mentioned earlier, more than 90% of companies listed on the prime market of the Tokyo Stock Exchange have responded to a request from the exchange in 2023 to disclose plans to improve capital efficiency. The third area is advancement of asset management services, which has a crucial role to play in channeling household financial assets into growth investments. Asset under management in Japan amount to about 1,000 trillion yen, 5 trillion pounds sterling. It has tripled over the past decade and continued to grow. However, the number of asset management firms operating in Japan remains limited compared with overseas markets. To address this, the FSA has put in place a Japanese version of EMP, Emerging Managers Promotion Program. We are working to promote new entry into the investment management business through easing regulations and encouraging financial institutions to use emerging managers. The fourth area is asset owner reform. As entities managing funds such as pensions, insurance, and endowments, it is essential that asset owners have in place robust governance and risk management frameworks to pursue the best interest of beneficiaries. To this end, the government developed the Asset Owner Principles in August 2024, setting out common principles that help asset owners fulfill their responsibilities. As of the end of last month, 337 entities have declared that they have adopted these principles. In advancing the initiative, we are also strengthening dialogue with stakeholders in Japan and abroad. For example, we launched Japan Weeks in 2023 as an annual event to strengthen engagement with global investors and promote the attractiveness of Japan's financial markets. The core week of Japan Weeks 2026 is scheduled for 26th to 30th of October, and the event is expected to serve as an important opportunity to communicate Japan's vision to become a leading asset management center. We also launched the Asset Management Forum in October 2024 as a platform for dialogue on increasing flow of household savings into productive investments and reforming the asset management sector in Japan. We have received valuable proposals from a wide range of stakeholders, particularly asset management firms in Japan and abroad.
The Japanese economy is expected to continue to grow steadily. We forecast real GDP growth of plus 0.8%, both in fiscal year 2025 and 2026. And I would like to emphasize that the Japanese economy is currently at a historical turning point, and structural changes in the economy are accelerating. First, getting out of deflation. Second, accelerating wage hikes. Third, increasing capital investment. This is a shift from a conventional economy of shrinking equilibrium and cost reduction to a growth-oriented economy supported by a virtuous cycle of wage hikes and capital investment. Prime Minister Takaichi is aiming for a virtuous cycle of wage hikes and capital investment. Wage hikes are expected to accelerate in the future as the economy moves closer to overcoming deflation. When wage hikes are implemented, the relative cost of labor will rise from the perspective of firms, which will in turn encourage them to invest more aggressively in plant and equipment. As capital investment is made and the capital equipment ratio rises, labor productivity will increase, which is expected to lead to further wage hikes. Some fund managers are still bearish on Japanese stocks because Japan's economy is growing slowly. However, this view is totally wrong. Japanese stocks are supported by strong microeconomic trends in corporate profits. And even if the macroeconomic data of nominal GDP is not so strong, there is still much room for Japanese stocks to rise. Here are 5 downside risks for the Japanese economy. Number 1, Trump tariffs. Number 2, deteriorating Japan-China relationships. And number 3, escalating tensions in Middle East and Ukraine. Number 4, sharp drop in yen exchange rate. And number 5, rising domestic interest rates. Prime Minister Takaichi is an outstanding leader, and she is currently maintaining fiscal discipline. However, in the future, the Takaichi administration's expansionary fiscal policy might carry the risk of sharp yen depreciation and a rapid rise in long-term interest rates. This slide illustrates the mechanism by which inflation and sharp yen depreciation might spiral in Japan. Against a backdrop of rising prices in Japan, real wages are declining. Therefore, to increase real wages per capita in Japan, structural efforts are essential, such as improving labor productivity and increasing working hours while ensuring employee health, rather than implementing short-term economic stimulus measures like consumption tax cuts. to boost Japan's economic growth, we need to increase 3 key factors: labor input, capital stock, and TFP. And the first key factor is labor input. According to our simulation, strengthening labor supply capacity may increase potential GDP by about 15%, 86 trillion yen in the medium to long term. This is the first key factor. And the second key factor is capital stock. First, in terms of the quantity of capital stock, comparing actual capital stock with optimal capital stock reveals that Japan's capital stock is deficient by approximately 250 trillion yen. And second, in terms of quality, the aging of equipment is depressing Japan's potential GDP by about 10%. Third, regarding the allocation of capital stock, potential GDP is reduced by about 18% because capital stock is stuck in low productivity sectors. So the Japanese economy has much room to grow, I think. And the third key factor is TFP, total factor productivity. And when comparing key factors affecting TFP with other countries, Japan lags behind in the following areas: investment in human capital, new business creation, worker diversification, entry of foreign-owned companies. Going forward, Prime Minister Takaichi must accurately recognize these challenges and work to improve TFP.
The reason why that's important to Japan is Japan was the first country through the sort of shrinking and aging of their population. And Japan has shrunk in terms of its population and aged very rapidly. But what's interesting, and let me just say this before I talk a bit more about what that means, is the next country through that is China. And China will age faster than Japan, and it will shrink, its population will shrink faster than Japan. Demography has 2 factors that shape it. The first is how long you live, and the second is how many children you have. What's very clear is governments and organizations can play a role in how long you live healthily. It can do that simply because, as in the case of Japan, the sort of cultural aspects of Japan encourage healthy living, or it can be, in the case of the US or in the UK, where you bring in sugar taxes and various other things. So government actually can encourage and enable people to live longer. But the second part of the demographic transition that Japan is going through, which is how many children you have, it appears that neither government or organizations can play any role in that. There seems to be the only thing that makes a difference about whether a couple decide to have children is the economic cost of having that child. And that's partly to do with the cost of schooling, but it's really more to do with the cost of child support and also the cost to the mother of being out of the labor market. And so governments and indeed organizations can play a role to support families to have kids, encouraging people to work longer. And we know, certainly from UK data, that people aren't leaving because they've reached the pension age of 65 or whatever it happens to be in any country. There's a large proportion of people who are leaving work before their pension age. So one thing that we can do, one of the advices to governments, is to think about each one of those problems of why people don't work. What can you do to increase health, which Japan is very good at, very, very good at healthy aging? How can you make work more amenable and pleasurable. And part of the way that you do that is to make it more flexible. There is a particular issue in Japan, specifically in Japan, about a multi-stage lives. You've got to have the opportunities to work as a freelancer, and you've also got to have the opportunities to set up your own business and to fail. And as you know, the entrepreneurial setup rates in Japan are rather low compared to other developed countries. So I would just finish by saying two other things. One is to encourage flexibility in the internal in organizations, but also to encourage entrepreneurship, because entrepreneurship is an enormously important way that people can carry on working by starting their own business. Can I just respond to this wonderful presentation about Japan? And I just wanted to make two observations. They could see that the hierarchy, which actually slows down what you do per hour. It's not about working more hours for any individual. It's actually about being more productive in those hours. And to be more productive in the hours, you have to reduce bureaucracy. So I just wanted to mention it, is software development. They were very aware that when they spoke to companies about their software development, Japan is a wonderful place to invest in, a very important country right now. And these seem like very simple things. So the first thing I'm going to mention is social cohesion. You know, when you see what the lack of social cohesion does to a society, does to its economy, does to its stock markets, you realize this is a very, very important, intangible, as I would say, asset. Japan's soft power, which is cultural, the way that some of the cultural aspects of Japan have been exported, you know, manga, for example, the cartoons, which are so important.
Well, there's tons of opportunity in the Japanese equity market for a global investor like our team. Secondly, it provides a lot of diversification away from US equities. The US equity market is 65% of global equity benchmarks, you know, is huge relative to the size of the economy, of the global economy, but also it's very concentrated in certain sectors and certain companies. So Japan, along with other international equities, is an important source of diversification. But even within the non-US equity market, it is highly diversified. It could, of course, the situation with Taiwan, Japan's proximity to that, and how China acts and resolves that situation is incredibly important for how we think about investments in the region, not just in Japan. But also it remains a highly cyclical, we think of it as a cyclical economy with lots of overrepresentation of industrial and consumer cyclical companies. So we have to be mindful of the global cycle, and it's more interesting to invest in Japan in an upswing. China is this emerging giant and incredibly strategic in its investment, whether it's electric vehicles, the battery supply chain, even the amount of investment going into healthcare and pharmaceuticals too. And there is a real risk of complacency. We see it when we talk to big companies. They say we're not losing market share, and that may be true in the short term, but over the long run, you see the growth of these emerging companies in China, and they are incredibly competitive. So we are very much encourage the companies we're investing in Japan to be investing, to be not cutting back on any of that, because China is a very important emerging threat. We should be seeing a much stronger yen, but we're not. And that is, that you can be explained by concerns over fiscal sustainability, and maybe there are other flow factors, but it's certainly something to watch. And maybe the risk is quite a rapid strengthening of the yen if these interest rate differentials hold. If we think about fair value, purchasing power parity, the yen could be at $100 to the yen, and that kind of unwind would, of course, be very traumatic in markets with all sorts of implications. So I think the stability or change over time would be fine, but we need to be mindful of the volatility. We get a huge benefit of operating from Tokyo. We have a team of local analysts, portfolio managers, support staff, and there's no substitute for that day to day, being able to call them up, have calls, then go and meet the companies. So that access that's made easy by the initiatives is super helpful, and it's a long-standing way in which we operate and foundation of the business. So that's incredibly important to the way we do our fundamental research. First is just around the continuation of governance reform. That has been focused so far on the kind of worst managed or governed businesses, but actually lots of good businesses in Japan hoard cash. And this chart's just showing over the last 5 years, the companies with the most net cash have begun to underperform the companies that have more efficient balance sheets. So we would hope, and we're certainly trying to engage, that good businesses are getting the message,